All right, we are live. All right, checking all the stuff. All right, here we go. Welcome to Money. Here we go. Good start to the week. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Hagren. Hey, Doug.
Good morning, Kirk. Hey, I looked out the window. I just want to report no drones in sight.
That's because you don't live in New Jersey, New York, D.C., Virginia. Yeah, if you were in those areas, you see drones everywhere. And it's funny. There's so much talk about that has nothing to do with the market, so we're going to try to keep it tight. But I think there are some lessons to pull from it. And I'll just say this. Hold on, I got to put my thinking hat on, also known as my tinfoil hat. So I have to say, what's really fascinating to me is the amount of craziness. People are absolutely losing their mind in the last few weeks. And coincidentally, it's between different presidential terms. But not that this doesn't happen every single time there's a transition from presidents, but I just think it's interesting right now that we're saber rattling against Russia. Assad's fled Syria. We have drone sightings all over New York, New Jersey, DC, Virginia, DC. I mean, everywhere. People are losing their mind. You get a CEO assassinated, cold blood, all within a short period of time. And
Has anything hit a bridge recently? Is it Arab summer? Because it seems a little cold out there for me. I'm just curious. Or Arab Spring. I'm sorry, Arab Spring. That's what they call it when all of the Middle Eastern dictatorships fell. Yeah, sorry.
Yeah, not in my backyard, Doug, because I have a hockey rink back there. So
yeah, it's like doesn't feel like spring to me either.
Yeah, so there's a bunch of stuff I just wanted to put out there, and then we're going to get into the finance stuff because there's a lot there too. But I just want to point out a few things. First, if you're watching the media, and I don't recommend it, if you're watching corporate media, and any one of them says, "Well, murder is bad, but," and then they go on to justify murder, just turn it off. Okay, just turn it off. The amount of idiots on TV saying, "Well, yeah, murder is bad, of course, but." You're justifying murder. What kind of idiot are you if you're sitting there trying to justify murder? That's all I'm going to say. I mean, I don't. I mean, it's so beyond ridiculous. But I have to say, and the reason I have my tinfoil hat on is because the tremendous amount of ridiculousness out there. Like I said, we've got drones scaring residents, which, in my opinion, is some sort of government psyop. Anyone who says, let's think of it this way. Okay. I'm just going to give you some thought experiments to think. And I'm not saying I have any answers, but like I said, I have this tinfoil hat on for a reason. If you're afraid that the drones are aliens or they're from another government, let me ask you this. If you ask the government and the government says, no, they're not from another government, they know exactly what's going on. They somehow know where these things are not from, but they can't tell you where they're from. It's a government op. And I'm not saying that they're deliberately scaring people. It could be for a host of different reasons. But I'm just saying, to me, it smells like a government operation. Now, they could be preparing for something. They could, whatever. They're just not going to tell us. And we just have to get over it. The other thing is, if I have a drone right above my house, I'm shooting that thing down. I don't even have a gun. I'm going to go out and get one. I'm going to shoot it down. Why? Because why the hell is there a drone right over my house? Right?
A guy did that in New Jersey. He actually fired his gun and shot one. And now I think he's been fined like $1,500 for the repair of it.
Repair of what? From whose drone?
Of the drone. They found
whose drone, Doug?
Yeah, exactly.
The one that they won't admit to, right? I mean,
absolutely. The one that doesn't exist that now has a hole in its fuselage.
Yeah, I mean, so I'd be out there with my 22 shooting those things down. I mean, realistically, if somebody wants to claim it, they can come to my house and give me a bill, and I'll know whose it is, right? I mean, it's ridiculous. I don't know. I mean, granted, let's be realistic. I mean, people are kind of losing their mind everywhere. So you got that. Now you've got the Luigi, who I have to say on both sides of this. On one side, people are buying the Luigi hats, like the green Luigi, like Mario and Luigi hats, and there's like 100,000 purchases in the last week. And if you're somehow celebrating this guy, what's wrong with you? I mean, he just killed somebody. And second of all, who knows if this guy even did it? They all of a sudden found him with, I mean, let's put this in context. The guy's sitting at McDonald's with the murder weapon, with all the evidence, with a manifesto, all sitting on him as if like all the evidence you ever need to convict this guy's right here. Really?
And he just happened to pull his mask down, and flirt with a girl like 30 minutes before he decided to do the shooting, in a place where there's always going to be cameras. Yeah.
Yeah. So here's a frame, and the reason I'm bringing this up is not because I want to talk about non-financial stuff, but I think as a frame. So if you're hearing something, right? If you're watching corporate media or some bumblehead on Wall Street, and they're saying something, and the first thing that comes to your mind is, really? Is that really going to happen? Now, if you find yourself saying that, then it's not true, right? So really, they found this guy with all the evidence sitting on him, just sitting there eating a hash brown at McDonald's. Really? And I saw something this morning. It was hilarious. I'm like, here's a guy whose family is worth $100 million, who's made in 100% of their profits off the healthcare industry, assassinating a CEO who's only worth 40 million. Like, really? Like, this whole thing to me just stinks. And if you look at the template of like JFK, right, is that the president was assassinated, and then they magically found a guy who didn't even know what was going on, and they pinned it to him, and then he gets murdered, right, by another guy who's just as fishy, and then the other guy loses his mind. Like, it's like it couldn't be more tinfoil hattish, but it doesn't mean it's wrong. So I wouldn't be surprised if this guy loses his mind or gets killed or hangs himself in prison. Like all these things, it's like not at all suspicious, right? So my point is not that I'm right or this whole theme is right, but to me this is like a Hollywood movie. They couldn't have made this more movie-esque. The only way they could have made it more movie-esque is by having Mark Wahlberg do it. I mean, look at Luigi. He's got these pictures on Facebook. He's jacked. Like, might as well be Mark Wahlberg, and now he's evading the police for like 2 months. He's going into hiding. Like, this is this is like a movie. So I don't know. To me, this whole thing stinks. I'm not really following other than just out of pure comedy, because this guy's become like Robin Hood, and he assassinated a guy, assuming he did. And I don't even think he did, but let's just allegedly he did. Let's say he did. It's just like, it's totally ridiculous. So if I'm making a movie, there's some guy who did it, and then they're pinning it on Luigi because they didn't like his family or some stupid thing.
Hey, I'd like to add one more thing. The OpenAI whistleblower was just found dead at age 26 in San Francisco.
Yeah.
Since you still got the foil on your head there, I just want to make sure that we throw it all in.
It's ridiculous. So, if you think about it, like you've got an administration which is obviously corrupt. I mean, if you can't see that, then you got to remove your tinfoil hat and your rose-colored glasses. But the whole political system is a mess, and the fact that all this stuff is coming, and that they're trying to start wars across the world right before the change of administration, it just stinks. So, yeah. But by the way, what's happened with Thomas Crooks? Have we heard anything even right after? Like, where's the news on that?
There's been some new things dripping out about him on Twitter recently that have just kind of stemmed from what happened with Luigi. But yes, no, we don't have a single answer on that one. Heck, we don't have a single answer on the dossier of, I mean, they still haven't talked about, Hunter Biden's journal. They still haven't talked about, Epstein. I mean, it's funny, the stuff that gets leaked and the stuff that miraculously disappears.
Yeah, it's totally ridiculous. The bullet casings have denied, defend, oppose. I mean, come on, this is like movie script stuff. You can't believe any. My point is, you can't believe any of it. Okay, that's why I got the tinfoil hat. You can't believe any of it. Just if you got a drone over your house, I'll leave it up to you what you want to do. But you can't believe any of this stuff. This is like fantasy land. Okay, so And this parlays into Wall Street too. And unfortunately I don't have a story that is movie-esque just like that. But the reality is it happens all the time, and you have to have your head, firmly screwed on correct. Now, let's see. Yeah, I won't share that. So, all right.
I do want to add one thing that I think just kind of exemplifies, again, regardless of who's in power, the corruption. I just saw something this morning, and I can't remember if it was 10 or 15 or 20 years ago, whatever the actual time frame was. But it used to be that I think they said 2 or 3 out of the wealthiest communities in the country, zip codes in the country, were around DC. It is now the top 5 wealthiest zip codes in America surround DC. If that doesn't tell you the amount of money that is in politics, and wherever there's money, there's going to be corruption.
Yep, there absolutely is. It's all kinds of crazy, but I guess the point here is that whatever's happening, as long as it doesn't affect you, turn off corporate media and go on your merry way. It's fun for entertainment as long as you know it's entertainment. But if you're going out and buying a Luigi hat, I don't know. I don't know what to tell you. So anyway, let's kind of dive right in, because there's a lot going on in the markets, and frankly, we have a super crazy bull market that is totally beyond belief. And I'm going to share a screen here. By the way, they just changed our settings over here for Restream that we use, so we're a little slow in getting some stuff here. But here we go. All right, let's see if I can get this. All right, so this is the wall of money. All right, so this is basically the U.S. equity ETFs and money flows. Huge amount of money flows going in November on the Wall Street. Okay. Now, I want everybody to remember this time of year is traditionally very bullish. It's what they call the Santa Claus rally. And it typically goes somewhere in November and goes in pretty much the first few days of January. Now, I will point out, and I'm looking for this and I can't find it at the moment, but I will point out that there are people who've done studies on this, and there's absolutely no correlation for the Santa Claus rally. It doesn't exist if you look at the data of like the last 100 years, and I'm trying to find it. Here it is.
Okay, you got it.
Okay, so basically, here's the average return, and then the median. So if you look at the Santa Claus rally, it's pretty much the same. You're not getting any variation. Month ends, you're looking at basically a very small sliver of difference. Now, if you're looking at, I'm going to keep flipping back and forth. Apologies to everyone, but here we go.
Does the correlation change if Die Hard is a Christmas movie?
I don't know, Doug. I'm with you. I think it is a Christmas movie. I was thinking about watching it last night, right alongside my Festivus pole that I have in the middle of my living room. So
I'm gonna say this really quick about Die Hard. For anybody that thinks it is not a Christmas movie, John McClane crawls through buildings delivering surprises to all the good little bad little terrorists and all the good little hostages. Right? They're trying to figure out who this person is. They're trying to catch him in the act. They want to know if he's myth or real. It is John McClane is a metaphor for Santa. I'll leave it at that.
I didn't think of that, Doug, but I agree. I think it's a Christmas movie anyway. So, ho ho ho.
Yippee-ki-yay. Okay, we'll keep it clean.
We'll keep it clean. So, all right. So this is the percentage change in the week before December in each year. There's no correlation for the Santa Claus rally. There really isn't. I mean, this is all over the place. There's not much there. Most years, now granted, this is a selective period of time over the last 20 years, but let's assume it's not a chart crime for the moment. I'm really not seeing any correlations. So, the Santa Claus rally, sell in May and go away, those kind of things, those are all Wall Street edges for like long time ago. And I don't have data to support this, so I'm going to be really crystal clear. This is a selective week before Christmas, and you could take different time periods, and the time period I would take is generally, the week after Thanksgiving up until January 1st. I think is traditionally how I'd see that. So it could be the data is showing different, but if personally, anecdotally, I feel like the Santa Claus rally does exist. It is a rare occasion that the market is not bullish this time of year and goes up. Now, if you're looking point to point, you can argue where it is. And honestly, I don't have the data, so I'm just talking anecdotally. It feels like it is real. I can tell you that it typically goes till about February, and then usually see a dip sometime in like early February, mid-February. You see a dip, a short-term dip, and then it's fine till like April or May. Anecdotally, that's how I don't have the data, but anecdotally from my experience, that's how I feel like it lines up. Also, I feel like the end of Q3 also lines up with selling pressure and changeovers. And I also feel like at the end of the year, you typically have tax loss selling for assets that are bottomed out. So if you're like, for instance, 2 years ago with crypto, perfect time to be buying it. I went and bought it the day before the end of the year and just went all in because it was getting hammered. It was already down like 65, 70%. And then you had tax loss selling to boot and just got hammered. That's when I picked it up. So if you're looking at assets that are bottomed out, or if you're looking at, getting out of things, you look at the year end as an opportunity to do that. If you're looking to change positions, I'd wait till January 2nd, just because, why take the tax hit this year? Just wait an extra day. But definitely something to be thinking about, because right now we're going to be going over this in the show. There's a lot of slides here which talk about the extreme bullishness that we have. And I'm going to share a few, and I'm going to let Doug share some. So here's one. This is the ranks of 401k millionaires, fresh high. Now, granted, this is a chart crime. This is 2019 to till today.
That's a long time of data there, Kirk.
It's a very, very short period. It was done by Fidelity.
Did they start that chart when Noah's Ark, was buried on Sinai?
The Shroud of Turin was found
somewhere, right?
Yeah. So, but this is done by Fidelity. So if it's done by a mutual fund company, you have to assume there's some bias in there, right? So I always do. This is actually one that's done by Fidelity that is maybe supported by Fidelity. Most times they do reports and then they put them out there in a news release and then they deny that it ever happened. It's just they're really good at that. But anyway, 401k millionaires. We have the most ever. We have, it looks like, about 550,000 401k millionaires, which is quite a few. But just something to think about. Like, we have an enormous amount of wealth being built up right now because things are just so bullish. Now, I'm going to show one or two more. Okay. Here we go. The Euphorometer. This is how euphoric the stock market is. In the last 30 years or so, it is the highest it's ever been. You pretty much have a period where I'd probably be a little cautious here. If you notice at the top, sometimes they top out a little bit. They bounce around, but many times they spike and then bounce down. So just something to keep in mind. Right now, I'm not seeing too many bearish signals. I'm seeing a handful, but mostly bullish signals. So I'm not bearish at all. I am mindful of the fact that we're in a really precarious place. Because of the amount of euphoria going on out there, and because of, let me show a different one. You also have foreign holdings, which are foreign assets, or foreign cash or assets holding U.S. assets. It is also at a all-time high, or at least for the last 75 years. So you have to keep in mind that there's multiple reasons for this. One is we do have generally decent economics. We do have some really interesting stuff, which I'm keeping an eye on, like inflation, which is not going away at the moment and could surge back. Depending on Trump's team's decisions, it definitely could come back. I suspect it probably won't like it did in the 70s. It's possible, but I don't think it will. I think if it stays a little elevated for a while, that's fine. But frankly, I think federal funds rate should be around 5.5 right now. I don't think they should have dropped it, but I think they're worried about the jobs numbers, which is the other thing. So jobs numbers is starting to look a little soft. That is something to keep an eye on. That is a measure that a lot of people look at. So if jobs numbers continue to weaken, then you should probably be a little cautious. Everything else looks great, and there's nothing to see here. And so I think everyone should just keep in mind that you have to be able to hold two scenarios in your head at the same time. And it's really hard for most people to do. Most people are either perma bull, perma bear, gold's great, gold's terrible, crypto's great, crypto's terrible, like whatever it is. Like it's really hard to hold two things at the same time in your head. So for instance, George Soros talks about this, and I use him as an example because he's one of the best traders of our era. He's also like the Dr. Evil character that everyone hates. So take that with a grain of salt. But he's had a lot. Thanks, Doug. Yeah, he's had a lot of success trading, and some of it has to do with probably connections and what have you. But definitely he's had a lot of success. And one of the things that he can do, and a lot of successful traders can do this, and I'm not naming them because off the top of my head I can't think of anybody that comes to mind, but there are a lot that do this, is that they have a thesis, and let's say their thesis is I'm going long the market. You go all in. You're like, all right, I'm going all in the market, and then the stock market drops like 2%. Then they start to short it, right? They have a thesis. They realize I'm wrong. It's going against me. I'm not only going to get out, but I'm going to short it. So that should tell you that somebody is really good at navigating markets, because markets tend to trend. And I'm not saying you down 2%, you short it. I'm not suggesting you do that. But the mindset required to do that is very rare. You have to train yourself to do this. Most people can't do it. I find it extremely hard to do. Maybe everyone else does too, and they're able to do it. But to actually realize you're wrong and go the other way requires a very flexible and agile mind, and 99.9% of the people can't do it. Just something to think about, right? It's kind of like the people who are Democrats who voted for Trump. Like, they're able to do that, right? They're able to hold in their mindset, like, I'm a Democrat and I'm voting for Republican, when people generally don't do that. Lifelong Democrats voted for Trump. That is that kind of mindset, right? It's hard to do. Like, most people are like, I don't care, I'm voting for Hitler, right? And both parties do this. Like, if you're Republican or Democrat, you're voting for whoever they put up there, even if it's Hitler. Or what was that South Park episode? What was it? The giant douche or the
oh yeah, the turd versus the douche, and he had to vote for the school mascot, and he refused. Yeah. He was the one vote that was going to break the tie, and everybody's harassing him to try to make that vote. And finally, at the end, he realizes, look, it doesn't matter who you vote for; they're always going to be a turd or a douche. So you might as well vote.
Yeah. Yeah, a turd sandwich or a giant douche. Yeah, and it's just like, So the point being is, in order for you to overcome that mental hurdle, which is pretty big, right? Because it's like going to watch a Red Sox and Yankees game, and you're a Red Sox fan and saying, well, the Yankees are winning, I'm gonna root for them, right? You're not gonna do that. Like, that's just not how it works. So when you have a team, you root for your team, win or lose, good or bad, right? They got a bum up there, they got Hitler pitching, you're like, go Hitler, like, it's just, people are like that. We're tribal. We're
springtime for Hitler.
Anyway, enough Hitler jokes. So
heroin next.
So we have a lot of right now. There's a very big divergence between income expectations and bullishness in stocks, and so this is really just the divergence. Is that you have expectations for income, you have expectation for stocks. There's not a lot of expectation for income going up, but stocks are through the roof. So if you look through all of these charts, you'll notice one thing, that sentiment is through the roof, really high sentiment. And the stock market prices are showing that. Now, sentiment, or some people would call animal spirits, I don't know why they called it that. I think it's the dumbest name ever, but The Economist did. So we'll give kudos to them for that word salad. But anyway, so I think the thing to keep in mind is this, is that you have to keep in mind that the stock market prices are going up. Sentiment is getting a little squirrely. It's really strong, but it's a little too strong, right? They talk about if everyone's on one side of the boat, it's going to tip over. So eventually people go to the other side of the boat, and then it goes back and forth. So you're better off being cautious right now. I'm not saying get out of the market. I'm not saying be all in cash. Not at all. I think you're irresponsible if you're not bullish right now. However, you should be cautious. You should be ready to jump at a moment's notice, because we're coming to the end of the year. I think we'll probably remain bullish or at worst neutral into the end of the year. And the thing to note is January 2nd or 3rd, whatever the first day is. No, January 2nd is the first day. I think it's a Thursday. So keep watch for that day and see what happens to the market. And if the markets start to really sell off, you want to be really mindful of that, really mindful. Because when things start to sell off at the end of the year or at the beginning of the next year, what will typically happen is a change in sentiment. And people do it for a variety of reasons. You're in tax loss selling. They decide that, a lot of it has to do with what they call window dressing. Window dressing is a term used for portfolio managers. And what they do is they basically look at the end of the quarter and they put all the stuff they want you to see that they own at the end of the quarter. So it's like, oh, quarterly report. What do they own? They own all these look at all these great stocks. It's a great mutual fund. Let me invest in it. Well, they probably sold it a week later. They just needed you to see that they held it at the end of the quarter. Stuff like that does happen. Okay. It's stupid, but it does happen. Optics matter. Let's be honest. Optics definitely matter. Hedge funds can easily do it too, because they don't have to report holdings other than quarterly. And then, hey, here are my holdings. And then I'm not saying they all do this, but if they wanted to, they easily could. So there's a lot of that shuffling of the deck chairs around that happens. So just be aware. And what I would advise everyone is to have a plan. You want to have a plan for what happens if the tide changes at a moment's notice. I'm not saying you get out. I'm not saying you run for the hills screaming. I'm just saying have your plan. If you don't have a plan, then you're just guessing. You're just gambling. And anytime you get in the market, you need to have a plan for when you're going to get out. Now, maybe your plan is you buy and hold forever. That's a plan. I'm not saying it's a great plan, but it's a plan. So if that's your plan, great. Know that. And so when the market's down 60%, don't get out of the market. Just say, all right, well, it's down 60%. I'm holding forever. You have to stick with your plan, whatever it is, good or bad. Make sure you know it and make sure you can stick with it. If you're down 60%, it's really hard for people to stick with it because that hurts. You're looking at your market and be like, yeah, I'm getting rich. And then now it's down 60. You're like, oh, I'm a dummy. I should have got out at the top. No, you shouldn't have, because it's hard to do. But the point being is just you have to be mindful of your mindset and just be aware. So when you're investing, just be aware of how you're doing it. Go ahead, Doug.
Okay. Yeah, no, I one of the things, and I apologize, I was flipping back and forth, so I don't know if you actually shared it, but in reference to your comments on the bullishness, did you show the chart with the U.S. consumers never been so bullish on U.S. stocks with divergence to income expectations at record highs?
Yeah.
Okay, cool.
Yeah, I showed that.
I didn't know.
Doug was looking for charts while we were talking, so
yeah,
yes,
exactly.
we did that.
Always looking around, but the other thing, what's interesting too, by the way, is another chart that was kind of posted. All right, so there's a gentleman out there, Jim Bianco. He posts some stuff that occasionally has I find has some value, and occasionally, like most of the things posted, does not. But what he did cite a reference that there's a study now, and we've talked about this for some time, that the 60-40 portfolio is dead. And so I actually have a gentleman, a client that I was working with, who's, was actually very frustrated by the results of the 60-40 portfolio. As we've talked about before, one of the problems with a static portfolio like that is, of course, that the 40 is supposed to be negatively or at least non-correlated to the 60, vice versa, in order to temper the volatility. Well, what often happens is that when times are bullish, then you do tend to find those correlations, and that tends to temper returns. And then when times are negative, people just indiscriminately sell, which means the correlation doesn't work when it's supposed to. But he found in the study is that they actually recommend now everyone should be 100% invested in stocks. Again, we're not telling you to go out and do that, but we've heard this from a number of different sources out there. Even, many people have quoted Warren Buffett saying that anybody that's investing, if you're not me, you should just go out and buy the S&P 500, which would be, of course, 100% stocks. But the new recommendation from the research is based on momentum, is that it should be 33% US stocks and 66% international stocks. He went into talking about the impact of momentum versus fundamentals. And of course, momentum works very, very well. And his point is until it doesn't. And of course, momentum can obviously, turn at any different time. There's some individuals have built incredible theses out there about following momentum that is, at one time, or at least look at back testing, looked really good. But if you try to follow that momentum, one of the problems is that by the time you see the trend and momentum change, it's already you follow that, it's already at the point where the momentum might be reversing. To counter that, what is very interesting is that somebody else did a study. Hedgeye posted, if you can find, it's a couple charts down there, Kirk, if you can see it. But now, granted, this is potentially a chart crime too, because this chart only goes back to 22, and I'm not talking 1922, I'm talking 2022. So we're only talking a 2-year trend here. But they're looking at, since October 13th, 2022, the MSCI EMU, so this is an index that tracks international stocks, has actually performed at the same level as the S&P 500 minus NVIDIA. So the argument here, at least in the short term over the last couple of years, which I'm sure is not going to be a surprise to anybody because it's in the news regularly, as is MicroStrategies, which has been using a lot of leverage to buy up. Bitcoin, wrong correlation here. But the point is, these are the things that are, NVIDIA has been a hot topic with AI. You could see that if we remove NVIDIA, at least during that 2-year period, the S&P 500 has not necessarily outperformed international stocks. So now, if you look at the international stock, the green chart, you can see that it has been a tremendous amount of volatility compared to the S&P 500 at the same time. I mean, you can notice it's definitely bouncing around a lot more, but the end result being effectively the same. And for a large part of that duration, the international actually outperformed S&P. There's some tools out there that do risk managed kind of allocations that have been calling for years for a higher allocation of international stocks. Now, I would say that if you have been following that trend over the long term, it has been a failing methodology, because obviously the S&P 500 has done so incredibly well over the in an extended period of time. It has been the best performing, main asset class in the world for over a decade. So clearly, but as we've talked about before, I mean, the S&P 500 was negative from like 2000 to 2013. So there is these times that things are going to outperform, and it has been an incredible run. But again, we also have to look at the amount of QE that's been injected. You look at the injection after 2008. You look at the injection that occurred to try to stave off of the issues of COVID. And there's the old saying, don't fight the Fed. Speaking of don't fight the Fed, right below that, we've talked about the deficit on record continuing to rise for the first 2 months of fiscal year 2025. So again, they're already spending into the next year. The U.S. has already hit an alarming $624 billion deficit. That is a 64% year over year, and even higher than the 2020 pandemic. So at this rate, the U.S. deficit could reach $3.5 trillion, which is incredible. So we are talking, again, money continuing to free flow. Now, what's the one thing to watch going into next year? All the talk is with the new presidency, we'll call it the new regime, is that they're talking about going in and cutting a lot of government waste. Will this happen? Again, they've got 4 years and they've got a lot of political headwinds to battle through. But again, if they're if again, correlation and arguably causation of a lot of free cash flow, whether it's the government or elsewhere, M2 money supply, leads to that money being injected, leads to inflation, leads to a lot of other, asset rising. Again, if those things get implemented, what's that going to do potentially to the U.S. stock market remains to be seen. Right below that, too, is also inflation-adjusted home prices. We are now at, and this is going back to 1890. So we finally have a chart that actually looks at data over an extended period of time. And if we take a look at the average, now for a long time, residential real estate, and they did studies on this and won Nobel Prizes around how much residential real estate actually increased over time. And a lot of people are like, oh, this is the best place to invest. And the start of that really happened as an advertising campaign for either Freddie Mac or Fannie Mae. It was really something that was, marketed to us that you got to buy in your home. And it's a place to sleep. And for a long time, the data did not represent a correlation to that. It was roughly 3%. I mean, housing kept up with inflation. And you can kind of see that if we go back to 1890 and look at the average price of a home, that really was pretty consistent up until right around just before late 90s, 2000. And then, of course, you looked at the home prices since then, and you've seen an exceptional amount of growth that, of course, was tempered by the decline of 2008. And this, by the way, comes from Robert Schiller and Zillow. But you look at the rise of housing since then. Now, if you take that average since 1998, along with the dip in 2008, housing over that period of time hasn't increased near to the level these charts look like because, again, the volatility is still significant there. But obviously, if you take it from 1998 and you held that real estate to present, and you look then and add that average in since 1890, we are clearly at a situation where we're not seeing 3% nominal growth. And that's led, the current generation to really truly see that, hey, it's not just the talk of hearing that real estate should be where we invest, but we're seeing those actual results and numbers. But again, we've seen such an injection of capital and free money and easy money and low interest rates over an extended period of time. What are we starting to see now? We're starting to see that obviously there is no housing supply, and pure and simple economics means you have demand versus supply. And if we obviously look at the demand is there, but for the amount of supply that has existed. Now, we were at a higher amount of demand for that supply when interest rates were lower. Now that they're higher, we obviously have, and you talk to mortgage professionals, they have seen a drop off in demand for mortgages, but you also are seeing a continual, reduction of supply because nobody wants to sell. Everybody's either sitting on, a free and clear home, or they're sitting on an extremely low interest rate that makes it, incredibly, it's counterintuitive to try to sell out of that and refinance and move. So everybody's kind of stuck. But as long as supply is low, and supply generally will have an economic lead, it's going to be a stronger impact generally than even demand is. Okay. So if you have very, very low supply, what's going to happen is you may only see some transactions, but those transactions are going to be in a seller's position to be able to command what they want. Now, it's got to be quality. If everybody's got money, then anything sells. And you saw the houses just, didn't matter. And I know you see this up where you live, Kirk. I mean, there are homes. I used to talk to people in New England. It's like, I didn't do anything. This house hasn't been updated in 50 years, and people are still willing to pay tons of money, right? Because of the population demand and supply. When we get to a situation where now the demand is tempered because interest rates are higher, it's more expensive to get homes, less people can qualify, and supply is low, that will show data metrics of a higher price per sale. But what's going to sell now has got to be higher quality. You're not just going to be able to throw anything on the market and actually see that's going to transact. Leonard Homes is now selling these new communities down in Dallas that are literally look like condos, detached townhomes. They are a garage with a living quarters right over it. They're selling anywhere from like $200,000 to $400,000. And they're being bought up by people who are just going to buy them and rent them. But they are giving massive price discounts. So we are starting to see the builders are starting to finally have to do things to get their supply moving for a while. And what are they doing? They're giving company incentives. They're self-financing. They're doing things in order to get that supply to move. But we kind of saw a lag where even as interest rates rose, the buyers were still selling pretty high volume. That has started to decline. A couple charts down, we can actually see where buying conditions have actually.
Well, hold on. Before you
Yep.
switch, I want to point something out
Please,
here.
go ahead.
You talked about the supply and demand pretty much for the last 25 years.
Yep.
I'll point something out a little different that is also possible. So this is the inflation adjusted home prices. Now, what is also possible is that inflation is a lot higher than the CPI is indicating. So the CPI might indicate it's a 2 or 3% inflation rate, but yet home prices are going up like whatever it is, like 50%. Well, maybe it's because the CPI is underestimating inflation, right? Because if you look here, if you look at for like the last 100 years, it's pretty much stagnant. I know it went down pretty much in the Great Depression, all that, and that makes sense. But otherwise, it's pretty much stagnant around here. And now you just get this huge spike. Well, one of two things is happening. Either, as Doug says, supply and demand, which is also very true. It also could be because the inflation is underestimating, which I think is very true. If you look at 2020, where they said, well, inflation, it's only, I forget what the number was. In the last few years, it's like 23% inflation. I don't know, at the grocery store, it's like 150% inflation because I know what I'm paying, and I'm paying a hell of a lot more than 20%. And so I think what's probably also happening, it's not either or, it's probably and. What's also happening is inflation is drastically underestimated. You can tell that by the wages. When wages don't go up and prices do, that's a sign that something's wrong. So just something to keep in mind is there are many reasons for this, but at the end of the day, it doesn't matter. What matters is price. The why doesn't come into it. We're talking about this to help you understand different aspects of this, but the why, it doesn't matter at all. All that matters is the result. So go ahead, Doug.
No, excellent point. And I think we've talked about this ad nauseum, and most people listening can see it. Actually, we'll show one of those charts at some point that shows inflation per category. But clearly, the things that, if you average out inflation based on all categories, it looks pretty good. But there's a reminder that there are discretionary and there are necessary goods, and it was a running joke after 2020 about the price of eggs. Guess what? They're back up again. Like all of a sudden, food is going on a tear. And so the things that you either need to survive or the things that most families perceive that they need are generally leading that inflation significantly. Average that out by things that you can, afford not to buy, like TVs. It's like, I don't need another TV. As prices are dropping, and it looks like inflation's isn't there. But that is obviously not what's hitting people's pocketbooks. And if you go a couple charts down on the same list there, Kirk, you'll see that the buying conditions, this came from University of Michigan, National Bureau of Economic Research, Federal Reserve Board, and Bravos Research, that the buying conditions for housing as surveyed by consumer going back to 1960. And buying conditions equals share reporting good conditions minus share reporting bad conditions plus 100. Don't need to worry about that. Just understand that. You look at the chart, you can see that this is the lowest since 1960 that we have, we're hit, that people that are looking to try to purchase a home are finding that right now the conditions that exist to do so are the most bearish that they've felt in 60 plus years. And then we add to that, the fact is, well, who's trying to buy home and how do you buy home? Well, Kirk, banks, and this is a reminder to people about real estate and mortgages. Banks are not, it's categorically false. It's a myth to call a mortgage a home loan. Okay. They do that. They package it. It's not a home loan. It's a personal loan to your income. The only reason they call it a home loan is because it's mandatory secured by your house. It's a way for the bank to justify. But what do we know? You don't walk in and go, hey, I got $2 million in cash right now. I'm unemployed. Give me a home. Look, I can buy that home, 4 of these homes. The bank won't lend you because banks only care about income for the most part, and they want to know, are you going to be able to pay that monthly payment? So if you have enough money to pay that monthly payment, they don't care how much cash, assets, and other such you have. Well, here's the problem with that, is that if we go now, Kirk, another one down, the labor market is finally cracking. New job postings on Indeed fell 38% year over year last week, now stand at the lowest since August 2020. They've now dropped for nearly 3 straight years. They're now down 49% since the February 2022 peak. So again, if not only you're trying to, you're looking at elevated mortgage interest pricing, which impacts buyers. By the way, we were saying this years ago when people are like, no, everybody wants a home. Banks will only lend based on the income ratio that you have. And if the payment is higher because of interest, and now you have the job market softening, those two things go into a correlate and sometimes even causate to a impact on real estate. And of course, it's definitely going to be related to the buying conditions that people are feeling. The last thing I'm going to add on here, let's see, we're talking about data. Most data strong. U.S. large bankruptcies are now up 634 year to date, the highest in 14 years. 32 more bankruptcies than the 2020 pandemic lockdowns. 69 large firms in November alone filed for bankruptcy. That's the second highest monthly total. Let's see, since a while ago. But we're looking at this chart. This chart goes back to 2010. So if we look at it, we're right in correlation with 2020, right in line with 2023. It's been kind of consistent. Now, the one thing I will say that, is that through November, we are higher than any other year since 2010. If we look at where we are year to date versus the rest of the year, we're in line with 2020 and 2023 and a little bit higher than other years. So for totals, we're not that far ahead, but we still have obviously a month of data. Housing defaults have just skyrocketed going back to 2004. We're seeing serious Freddie Mac reporting serious delinquency rates for multifamily housing. So that's obviously, this is delinquency rates of multifamily. So people that were buying housing in order to rent out. So we have a lot of the investors that may have bought in at higher pricing are struggling a little bit. And the income needed to buy a house the last 225 years has now been elevated. This talks about inflationary, the inflation adjusted, the annual income needed to buy a house. If we just go back to let's just say about 2012, it was only about $38,000 needed to buy a house. Previous to that, right around 2000 and the recession, 2008, 2007, it was 61,000. Since 2012-ish, it has gone up almost a straight line to now being 109,000, almost 110,000 gross annual income needed to afford mortgage payments at 30% cost ratio. Again, what does that mean? It means that you just killed demand, because banks are going to require, if income didn't go up and banks are now requiring for that 30% cost ratio, they're not going to lend. You're cutting out a massive segment of people that could have afforded a house just 10 years ago. But yet at the same time, percentage of respondents expect stock prices to rise in the next 12 months, significant highest ever. So that goes back to the chart you said earlier. We are seeing, we're seeing a separation between income expectations and what things can afford versus what the market expectations are. So what it tells me is there's a lot of people that are seeing seeing the positives in the market. They're very bullish, right? But some of that bullishness, Kirk, I believe isn't necessarily based on what they see in the data. It's called hope. They're hoping it goes up because that's where people are betting their opportunities are going to come from, which has been something that I believe now, if you look at where people's wealth are, like we saw, 401ks are over $1 million. Have significantly spiked. A lot of people are successful based off what's happening in the stock market and home equity. But now we're up to 12.6% of FHA mortgage loans are delinquent. Over 22% of FHA loans with a credit score of 500 to 619 are now delinquent. So the question is, where did subprimes go? Last but not least, there was one other chart that I was going to look at if I can find it quickly. And I'm not fine. Oh, it was it's a little bit higher. There was a question, manufacturing. So manufacturing jobs, if I can find it, where did it go? Oh, manufacturing job openings are plummeting. The job openings in the manufacturing sector fell to 465,000 in October. That's the lowest since the 2020 crisis. Over the last 2 years, manufacturing jobs have halved. Now, what does that mean? Well, some people would argue the job market is weakening. You could also argue, again, as we've seen for decades, maybe those jobs are just ending up somewhere else. But the point is, those impact us here. So, a lot of our economy is driven by people that still work in the manufacturing sector. And so, again, they like to say that if these jobs terminate, that they'll end up doing something else, that they've been retrained. That does sometimes end up being the case. But the question is, in the short term, is that bullish? It's not. Again, overall, I just wanted to counter some of the things that Kirk was saying. Overall, data is very high and very strong in most categories, but there's definitely some cracks in the system and people need to be aware of.
Awesome. Well, we're going to wrap it up here. We got 1 minute left. Doug, where can people find more about you?
Well, we just talked about inflation, as we often do. And one of the biggest areas of inflation that is hitting people, that when people consider a need, is tuition, college, education costs. This is something that is an emotional need for families. And now, obviously, college can mean trade schools and such. It can mean 4-year education. But overall, the majority of schools in this country actually have below 70% and below 60% 4-year graduation rates. They actually have somewhere in the range of 60 to 7% 6-year graduation rates. I don't know if you're factoring that into your calculations. So the school you select matters, and so does how you pay. And how you pay can be finding the lowest cost to school that fits the right school for your child academically, financially, and socially. But it also can be being more efficient with the money you have. That means cash flow strategies, tax strategies, finding money you're losing unknowingly or unnecessarily. Would it help to pay for college if you could find $10,000 more per year or more than that in terms of tax strategies or other areas of better efficiency with your money? If it would, that's certainly going to make college cheaper. And most people don't know about those tricks. I can do this on my own, but at the end of the day, the reality is they're missing tens of thousands of dollars of potential per year in not only scholarships, but efficiency in how they pay and strategies to do so. If you want to learn more about that, our organization has those tips and help and guidance. MERGENTcollegeadvisors.com. I'm going to spell it for you because it's a little bit off. It's MERGENT. MERGENTcollegeadvisors.com. Go check it out. Get some information. If you have any questions, let us know.
Great. Well, Doug, always appreciate you coming on the show here. And that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a sharing and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.